Imagine walking into your favorite discount store, that familiar green logo, right? And you get that little, I don't know, thrill of the hunt. You know, the feeling, digging through the aisles, finding something surprising, maybe something you didn't even know you needed, all for a fantastic price.
For decades, yeah.
For decades,
Yeah.
that thrill has been synonymous with Dollar Tree. But what if I told you that familiar name is undergoing a massive strategic overhaul? We're talking changes that will redefine what a dollar store even is.
It's truly a fascinating moment for retail, isn't it? This isn't just about like a new product line here or there. It's fundamental, a reimagining.
Right.
Our deep dive today is based on their recent 10K filing, which is, well, it's basically a treasure map to understanding not just what Dollar Tree is doing, but, why they're doing it.
And what it means.
And yeah, perhaps most importantly, what this all means for their future and ultimately for how you shop in the discount retail space.
Exactly. Our mission today is to unpack this mountain of information, dig out the gold, and make sense of the dizzying array of changes happening behind those bright green storefronts.
Okay.
We're going to explore a huge strategic shift involving a major part of their business, dive into how they're changing the very core of their store experience with new pricing strategies, and look at the financial and operational challenges they're wrestling with in a really, really dynamic economic landscape.
So let's unpack this transformation.
Okay, well, Dollar Tree is, and for a long time has been, a powerhouse in discount retail. They currently operate over 8,800 Dollar Tree and Dollar Tree Canada stores across the U.S. and Canada.
That's a lot of stores.
It really is, and they built their brand on convenience, value, and that thrill of the hunt experience, where customers can discover new celebratory and seasonal items weekly.
Yeah.
It's core to their identity.
But that core identity is shifting dramatically, especially when it comes to pricing. For so long, it was literally everything's $1, then it went up to $1.25.
Now get this. They're strategically expanding into what they call multi-price assortments. We're talking about introducing products at $3 and $5 in discretionary categories, and even $3 and $5 items in frozen and refrigerated sections. This isn't some small pilot program either.
No, not at all.
By early next year, specifically February 1st, 2025, approximately 2,900 stores will be operating in this multi-price format. That includes 2,600 conversions of existing stores and 300 brand new locations.
And what's truly insightful here is the why, the strategic rationale. They state this move aims to provide greater value to customers, increase foot traffic, and crucially, significantly improve store productivity.
So more stuff to buy, get people in the door more often.
Exactly. It's an acknowledgement that the single price point, while iconic, also, it limited their ability to offer a broader range of products or maybe extract more value from their existing customer base. It's a clear play to capture a larger share of your wallet.
And they're not just changing prices in existing stores. They're aggressively expanding their physical footprint and modernizing the whole experience too. Think about this.
Yeah.
They just acquired leases for 164 former 99-cents only stores.
Yeah, I saw that across Arizona, California, Nevada, Texas.
Right, and they've already opened them as Dollar Tree stores. On top of that, they've secured rights to convert around 138 Party City stores into Dollar Tree locations.
If we connect this to the bigger picture, it demonstrates a clear commitment to both physical expansion and the strategic repurposing of existing retail spaces. It's quite clever.
Yeah.
Beyond these acquisitions, they're also investing broadly in opening new stores, expanding into new geographies, and undertaking significant renovations to, optimize the in-store experience.
Make it nicer to shop there.
Pretty much. And in a nod to modern convenience, they've partnered with Instacart. So same-day delivery from over 7,400 Dollar Tree stores as of early this year.
Okay, so on one hand, we see Dollar Tree aggressively investing in its core brand, doubling down, really. But while they're doing that, they're also making a pretty painful decision to untangle themselves from a past acquisition that didn't quite fit.
Family Dollar.
And that brings us to arguably the biggest, most dramatic move detailed in this 10K, a complete strategic divestiture.
Indeed. Dollar Tree initiated a formal review of strategic alternatives for their Family Dollar business back in fiscal 2024. This extensive review culminated in the decision to sell.
So they looked at everything and said, nope, gotta go.
Essentially, yes. On March 25, 2025, they entered into a definitive agreement to sell the Family Dollar business to Brigade Capital Management, LP, and Macellum Capital Management, LLC.
And the numbers involved are substantial, right? A purchase consideration of just over $1 billion,
Brilliant, yeah.
with estimated net proceeds of about $800 million. It's important to note, though, this is still subject to U.S. antitrust approval.
True, that hurdle remains. And at the time of the agreement, Family Dollar was a truly massive operation itself, over 7,600 stores and 10 distribution centers. This raises an important point about the profound impact on Dollar Tree's overall business profile. The filing explicitly states this sale will make Dollar Tree a smaller and less diversified company.
Makes sense.
Which increases its exposure to risks inherent in just the remaining Dollar Tree banner.
Yeah.
And the financial fallout from this decision is already strikingly visible in their fiscal 2024 results.
Yeah, I saw that number. They reported a net loss exceeding $3 billion for fiscal 2024. That's a truly eye-watering sum.
It is, yeah. And the filing meticulously breaks down the specific charges contributing to that colossal loss. It includes a $1.4 billion trade name impairment.
Basically writing off the Family Dollar brand value.
Exactly. Wiping the slate clean, signaling a definitive move to shed that perhaps negative association. There's also a nearly $500 million goodwill impairment, over $80 million in long-lived asset impairments, and a massive $3.4 billion loss directly from classifying Family Dollar as held for sale.
So all tied to getting rid of Family Dollar.
All directly related, yeah. It just illustrates the immense financial costs of disentangling such a large and maybe underperforming enterprise.
Talk about a dramatic realignment. Okay, now, beyond that massive divestiture, Dollar Tree is also navigating a pretty challenging economic landscape, which is visibly impacting its day-to-day sales and overall profitability.
Absolutely. In fiscal 2024, their comparable store net sales saw, a modest increase of 1.8%.
Just 1.8%.
Yeah, and that growth was primarily driven by a 1.6% increase in customer traffic, so people coming in, but only a very slight 1.1% uptick in average ticket size, what people are buying. This is a noticeable slowdown when you look at previous years. They had like 5.8% growth in fiscal 2023 and a really robust 9.0% in fiscal 2022.
Okay, so while people are still walking through the doors, maybe even slightly more, the overall growth rate has definitely slowed down. What's causing that kind of pressure?
Well, the company directly attributes it to the broader macroeconomic environment, specifically citing, inflationary pressures and higher interest rates.
The usual suspects.
Pretty much. They anticipate these trends will continue to impact their customers and sales in the near to midterm. There's also been a discernible shift in consumer purchasing away from higher margin discretionary stuff towards lower margin consumable goods. Groceries, cleaning supplies, that sort of thing.
Which naturally hits their bottom line harder.
Exactly. And those profitability pressures extend beyond just shifting consumer habits, right?
Second.
Precisely. Their gross profit margin, for example, decreased from 37.5% a couple of years ago to 35.8% in fiscal 2023.
Okay.
This was largely due to reinvestment in those value product assortments after the $1.25 at price point transition, the increased sales of those higher cost consumable items we just mentioned, and rising distribution and shrink costs.
Shrink. The bane of retail.
Always a factor. And on the expense side, their selling, general and administrative, or SG&A, expenses have climbed significantly, from around 24% in fiscal 2022 to over 27% in fiscal 2024. That's a substantial jump.
What's driving that up?
It is. The filing attributes this to several key factors. Significant investments in wages and minimum wage increases for store payroll.
Labor costs.
Big time. An unfavorable development in general liability claims, which saw an increase of over $20 million in fiscal 2024 alone.
Ouch.
And higher repairs and maintenance expenses, which kind of reflects their renewed focus on improving store conditions, maybe catching up on some deferred maintenance.
Right, trying to spruce things up.
All these factors combined have led to a decline in their operating income margin. It fell from over 13% in fiscal 2022 to just over 8% in fiscal 2024. It paints a pretty clear picture of rising operational costs eating into profits.
They also highlighted some fascinating and sometimes, unfortunate details about their supply chain and the costs associated with it.
Yes, a strong and efficient distribution network is absolutely critical for their low-cost operating structure. They currently operate 15 distribution centers in the U.S., with plans to convert the Odessa, Texas Family Dollar DC into a Dollar Tree facility by the second quarter of fiscal 2025. They're investing in their truck fleet, transportation management systems, and even a new Rotacart delivery process to streamline store
A
delivery.
Rotacart. Okay, what's that? Sounds interesting.
It does, doesn't it? It's apparently a wheeled container that's loaded by category for quick, easy store deliveries. And it's nestable for easy return. It's a clever detail aimed at boosting efficiency in the stores.
Makes sense. Roll it in, unload, roll it out.
Exactly. But despite these innovations, they face persistent cost pressures from, global ocean shipping rates, domestic freight, fuel costs, and tariffs.
Still feeling those ripples?
Oh, yeah. For example, they incurred an additional $25 million in duties just on paper plates in fiscal 2024 alone.
Wow, just for paper plates.
It's just paper plates. And like many companies, they're challenged to attract and retain enough workforce for their distribution centers, leading to increased wage expenses there, too. Plus, they had a major setback in fiscal 2024 when a tornado completely destroyed their Marietta, Oklahoma distribution center.
Oh, I remember hearing about that. Terrible.
Yeah, causing significant additional supply chain costs as they had to pivot and service the, hundreds of affected stores from other locations. It's a reminder that even the most meticulously planned operations can be vulnerable to the unexpected.
Absolutely. Okay, so we've looked at the big numbers, the strategic moves, the divestiture, the economic pressures, but a company's true strength also lies within its walls, its people, its vulnerabilities, and its commitment to ethical operations. Let's peel back another layer and examine how Dollar Tree manages these internal dynamics, starting with their investment in their people.
Right. And what's particularly striking here is just the sheer scale of their workforce.
Yeah.
Over 214,000 associates as of early this year.
That's huge.
It really is. The company emphasizes a strong commitment to its people, offering competitive pay and benefits. They mention gender and racial pay equity, and a 401k plan with a dollar-for-dollar match on the first 5% of contributions. They also have an employee stock purchase plan.
So some decent baseline benefits. What else?
Beyond compensation, they offer educational assistance, paid maternity and parental leave, and, interestingly, financial support for associates recovering from natural disasters. It sounds like they're putting a big emphasis on talent development and retention through training, tuition reimbursement, and leadership programs.
Trying to build from within.
Seems like it. They recognize that their people are, foundational to their success. However, operating a business of this scale also means navigating a really broad range of local, state, and federal laws and regulations.
Oh, it's complex.
Which leads to significant ongoing compliance costs and sometimes, more serious legal entanglements.
Yes, and they've been in the news for some of this, haven't they? They disclosed that Department of Justice investigation regarding a historical rodent issue at a Family Dollar distribution center.
Right, that was a big story. It resulted in a guilty plea for a misdemeanor violation and a payment of over $41 million in forfeiture.
$41 million. That's not small change.
Not at all. And it highlights the serious risks of things like product recalls and product liability claims, which can severely impact a company's reputation and, of course, its bottom line.
Definitely. Another crucial area for any modern retailer, particularly one so reliant on efficient operations like Dollar Tree, is cybersecurity.
Oh, absolutely critical. Dollar Tree relies heavily on computer and technology systems for nearly all key functions: inventory management, point of sale, logistics, everything.
So how are they protecting themselves? Their defense against cyber threats sounds quite robust on paper.
It does. They describe a comprehensive cybersecurity risk management program, including controls, technologies, processes, and annual assessments using the industry standard NIST framework.
Okay, the NIST framework, that's good.
Yeah. They also have a dedicated Chief Information Security Officer, a CISO, and their audit committee directly oversees these risks. They even have a detailed cybersecurity incident response plan and periodically conduct tabletop exercises to test their response capabilities.
Practicing for the worst case.
Exactly. And while they state no material incidents occurred in fiscal 2024, they do acknowledge the growing sophistication of cyber attacks and the significant investments required to continuously strengthen their cybersecurity posture. It's just an ongoing battle for all businesses in today's digital landscape.
No doubt. Speaking of company integrity and internal controls, the 10K also details their insider trading policy. This is designed to prevent trading on material, non-public information. Standard stuff, but important.
Very important. The policy is quite thorough, defining covered persons, which includes officers, directors, employees, and even their family members, and covered transactions like stocks and options. What's considered material non-public information is also clearly outlined, with examples ranging from earnings changes and mergers to, interestingly, significant cybersecurity incidents. It's all about ensuring a level playing field.
Makes sense. And they enforce blackout windows, right?
Yeah.
Periods when trading is prohibited, especially around financial reporting.
Yes, standard practice. And for certain individuals, like directors and VPs, pre-clearance of any transaction is required. They have to get permission first. What's particularly interesting, though, is the detail they provide on Rule 10b-51 plans.
Ah, yes, the pre-scheduled trading plans.
Exactly, those are crucial. Rule 10b-51 plans offer a sort of safe harbor for pre-planned trading. They allow certain individuals to buy or sell securities on a predetermined schedule, even if they later come into possession of material non-public information.
So it helps avoid accusations of insider trading.
Precisely. But these plans have strict requirements, including a cooling-off period. For directors and Section 16 insiders, that's at least 90 days after adopting the plan, or 2 business days after financial results are disclosed, up to a maximum of 120 days.
Okay, quite specific.
And for other employees, it's a 30-day cooling-off period. It's all about ensuring fairness and preventing any undue advantage.
And the consequences for violating this policy are serious.
Oh, yes, ranging from internal disciplinary action, including termination, right up to potential legal penalties. They even encourage reporting violations internally. This really underscores the company's commitment, at least on paper, to integrity at all levels.
Right, okay, so what does this all mean when we bring it all together? Dollar Tree is clearly in the midst of a very, very significant strategic transformation.
No question about it. They're shedding the Family Dollar business to really sharpen their focus on the core Dollar Tree brand. This isn't just a pivot. It feels like a massive reorientation that signals a clear future direction.
And it comes with substantial strategic investments planned for fiscal 2025, right? Between $1.2 billion and $1.3 billion.
That's the plan. These funds are earmarked for critical areas like supply chain improvements, opening new stores, significant renovations, and technology upgrades, all aimed at driving future growth and improving the customer experience under that core Dollar Tree banner.
It's a delicate balancing act, though, isn't it? They're managing these ongoing cost pressures, like from inflation and rising wages, while also seeing consumer preferences shift towards those lower margin goods we talked about. All of this is happening amidst a complex economic and regulatory environment while they're trying to execute these really large-scale initiatives like the multi-price rollout and store upgrades.
Exactly, it's a lot to juggle. Despite the significant net loss in fiscal 2024, largely due to the Family Dollar divestiture charges, the company does highlight its robust cash flow from operations.
Which is key.
Absolutely. Plus, its ongoing share repurchase program, they still have nearly $1 billion remaining under authorization there, and new credit facilities they've secured. These measures sort of underscore their liquidity and their ability, hopefully, to fund these ambitious future plans, even as they navigate this really transformative period.
This entire deep dive reveals a company making some incredibly bold and, you could argue, at times painful moves to redefine itself for the future. It leaves us with a big question, really. How might Dollar Tree's sharpened focus on its core brand and its multi-price strategy reshape the landscape of discount retail? And maybe more personally, what does that mean for how you shop in the coming years?